Hey, what's up guys? Another video here. So today I want to talk about what to invest in from a general perspective. So I've discussed in the prior video to buy assets and not liabilities. So what are these assets? So what you should buy generally to diversify your portfolio or just in one quick step are index funds. So again, I want to state that this is not financial advice, this is purely my opinion, so just take it with a grain of salt. But a very good company that has low cost index funds, meaning that they're passively managed, is Vanguard. So Vanguard provides so many different index funds, again with a low cost, low fee structure, so that's probably an advisable company to go with, and they have trillions of dollars under management, so you can rest assured that it's fairly safe to invest in this company, a long established company. But anyways, two funds that don't require a large commitment as far as initial dollar investment are VTI, so V as in Victor, T as in Tom, I as in ice cream, and VGT, so V as in Victor, G as in Gary, T as in Tom. So VTI is general exposure to the US stock market. So again, it has a good track record of returning, X% per year on average. Again, there are downturns in the market, but generally it goes up, and again, it is a fairly safe index fund to invest in. So that is a VTI. So you can go on the internet and research what the current holdings are in VTI, but again, it is a fairly safe fund. And there is another class of shares, VTSAX, that requires an initial investment of a few $1,000s, but again, that is a fairly safe fund. Again, it's with a company that has a low fee structure, so again, it won't be eaten up by, for example, an actively managed mutual fund. And the other fund, VGT, that is more focused on the tech sector, so it'll have holdings in companies such as Microsoft and Apple, and again, it has a low fee structure, and it is a bit more aggressive than VTI because of the nature of the companies that they invest in, but it has historically returned, fairly aggressive return. But again, when tech stocks get hit hard, that they kind of nosedive quickly. But in both instances where you invest in VTI or VGT, if there's a downturn in the market, you simply DCA. So DCA is short for dollar cost averaging. So you can't really lose in the long term. So if you are a very long horizon investor and you invest in either of these index funds, again, it's just one of thousands and thousands and thousands of funds that you choose from. But me in particular, I like these funds because again, the low fee structure and the type of holdings they have and the track record of the investment company Vanguard. So in either case, if you DCA or dollar cost average into these funds, then you'll at the end have a great return. Because you are lowering your cost average if you are investing during the downturn, and then when it goes up, then you win. So in any case, you are winning because these funds also have a dividend return where you can reinvest into the fund. So the dividend rate is actually quite lower than, for example, another stock like AT&T, where the dividend rate is at about 6%, but that stock doesn't appreciate as much as the general dollar figure or the general value of the index fund. So the index fund value rate will go up over time, while if you do a stock such as AT&T, where the value will not fluctuate too greatly, but it does have a really good 6% dividend rate. So maybe after you acquire your multi-million dollars of wealth, you can invest in a portion of that fund into a very high yielding stocks such as AT&T, or you can research any type of large mega cap stocks that have a very good yield. So you can easily find that on the internet. I believe another One is Procter & Gamble, and other companies that have a regular dividend or have a historical history of providing dividends either on a quarterly basis or a semi-annual basis or even an annual basis. So it's really important that you do your research, but again, finding a low-cost index fund to invest in, which again automatically diversifies your holdings, because index funds in and of themselves have a variety of companies that they invest in or that they hold shares in. You will have already the broad market exposure. So VTI for more of the general US stock market, and VGT more for the tech side, which is more aggressive, which may yield higher returns, but also if there is a downturn in the market, especially in the tech sector, it's going to drop more aggressively. So you have to manage your risk, and you have to decide if you're more risk averse, or you can more really accept the risk and accept the fact that when it does go up, it'll go up more sharply, and if it goes down, it'll drop more quickly. But again, with the strategy of DCA, dollar cost averaging, you really shouldn't have a concern if you're a very long-term horizon investor. So outside of investing in those index funds, which I suggest a beginner goes into, you can also invest in individual stocks. So you can do that, or even now people invest in cryptocurrency, which is extremely volatile. So it just depends on what your risk profile is. So let's say you invest in some individual stock, you can experience wild, very high gains, and again, that will be very advantageous if you pick the right stock. But who knows if you can pick the right stock? So you really have to sometimes throw the dice, maybe give a certain percent of the money that you allocate into a certain stock, and then maybe invest the majority or half into an index fund, which is a lot safer, has a diversification of assets. So you shouldn't really put all your eggs in one basket, but if you put all your eggs in one basket, it can really turn out well for you, or you can really be crushed by it. So I don't suggest a beginning investor invest in individual stocks or anything else too volatile, but as you build your assets, you can start looking into individual stock, and again, that's subject to your own research. And again, if you're investing into an individual tech stock, you can't really rely on traditional metrics like PE ratio, because a lot of these companies that are starting out in tech, they have huge liabilities and possibly negative cash flow, or they're not turning a profit on their balance sheets. So you shouldn't really rely on traditional measures for that. But if you do get into a company, it can do really well. For example, if you invested in Amazon like really long time ago in like 1999, and now you have been rewarded very handsomely. Otherwise, if you invest in companies like, for example, Twitter and Snapchat, they haven't really done much since their IPO. So you're really rolling the dice on these type of companies. So if it turns out well, then you'll be very handsomely rewarded. If it doesn't turn out well, you will either stay stagnant or lose your money. So it's not really advisable for a beginning investor to look into individual stock, but it's definitely a strategy that I personally have used and have done well in. But again, that's subject to your own research and if you're risk averse or not. So again, just to recap, again, not financial advice. Number one is to invest in a low-cost index funds, such as something from Vanguard. So the two funds that I suggested were VTI and VGT. Otherwise, after you build your asset base, for example, you do your 401k, which is another topic, and you have your personal holdings of index funds, you can go into more risky assets such as individual stock, or again, like I mentioned, cryptocurrency, if you choose to. But again, you have to remember that individual stock and any other type of volatile asset is subject to really fluctuate largely in price. So if you can't handle that type of volatility and risk, then I don't suggest that you do it. So if you're a more risk averse person, then I wouldn't suggest those risky assets. But if you just kind of want to stay the course and you have a very long-term horizon and you suspect that you'll work X amount of years, then highly suggest in low-cost index funds. So if you have a mutual fund that's actively managed, it'll be eaten away more by fees, which is popular in 401ks. So again, another subject, but 401ks, I suggest you invest up to what your employer provides for match. But otherwise, if you want to take additional risk, and if you want to grow your money in more more risk reward type assets, then you may want to place a lot of money that you would otherwise allocate to your 401k into after-tax brokerage accounts. But again, that's definitely a case-by-case situation. So if you're the type of person that wants to allocate your money, or wants the money not to appear in your paycheck and just automatically be diverted to a 401k, then maybe you should go for that. Otherwise, you have the option of investing your after-tax dollars in somewhere else. So thanks guys again for watching, and and I'll probably go into other topics regarding investing, but this is I think a good introduction for investing. So that's it guys, and thanks.